Why don't we start with the announcement from the Bank of Canada just a couple of days ago about interest rates?
So the Bank of Canada a couple days ago held their rates steady. The rationale behind it, of course, we have a lot of uncertainty in the market right now with the tariffs on, tariffs off. We've got 50% tariffs now on steel. They were 25. All of a sudden they became 50. So there's a lot of this uncertainty right now in the marketplace that the Bank of Canada is looking at. But more importantly, the Bank of Canada has a singular mandate essentially, and that is to keep inflation low. And to keep it low means to keep it at 2% or less. And even though the headline inflation number you'll say is, well, the headline inflation is 1.7%, which is less than 2, the core inflation is the biggest challenge. So right now, with core inflation, we are at 2.5%, which is of course higher than the 2, but CPI trimmed inflation, and CPI trimmed inflation is a Bank of Canada favorite. What it does, it takes away the volatile top 20 and the bottom 20% and just looks at the middle 60% of data. And that number came in at 3.1%, so much higher than the 2%. So even though we look at the headline inflation and say, hey, it's 1.7%, looks pretty good, it's that core inflation of 2.5, and in the United States, the core inflation is 2.8, and it's that CPI trimmed mean year-over-year inflation of 3.1% that's leading the Bank of Canada to reconsider potentially lowering rates because that might fuel those numbers more. And again, they keep their mandate at a 2% inflation rate because they see that as the best way to bring about investment in Canada, to bring about jobs in Canada, to increase the job numbers and increase everything overall, is to keep that inflation number in and around that 2% mark.
And Tracy, am I right to say that for the average consumer that may not understand what each of these numbers means, it just leads to uncertainty and instability as to whether they spend or not, right?
Absolutely, Mark. I think a lot of clients and potential homeowners were sitting on the sidelines hoping to see that reduction in bank prime this week. When we didn't have it, it did cause some concern that there's some volatility in the economy. The big question I think a lot of people are talking to me about is their employment. Are they going to be employed in the next 6 months with tariffs? Is that going to impact them? And so what happens is that people become shell-shocked and they don't make a decision when realistically they might be in a great place of employment and have saved the money, and interest rates have come down from last year quite a bit. And they're in an opportunity to be able to buy because it is a buyer's market. So they're not because of, again, news like today. It's disappointing to see that we don't have a decrease like to what Bruno has talked about. I think there is a lot of indicators in our economy in Canada that leads us to see that we should have a decrease in bank prime. Do I think we'll have some more this year? I think that logically it looks like we should. And I think that we'll have to see what happens over the next probably 30 to 60 days with tariffs and the impact of how higher our unemployment rate goes and what happens, across the border in the U.S. with tariffs. But it's a hard time for people. It's a hard time for people to look through all of that and make a logical decision of should I buy a home today or not.
Yeah, and I guess looking ahead, it must be a question both of you get quite often. Okay, what's going to happen for the rest of the year? And I feel like it's a giant question mark right now.
It is. Overall, if you look at where most economists' sentiments are on the forecast of where bank prime will be, they're still stating a potential 75 basis point reduction by the end of the year. We still have a couple of announcements. There's about 4 Bank of Canada announcements by the end of December 2025. And we still might see that. If we don't see that 75, we should see at least 1 or 2 reductions. And that will help people. It'll help people for a lot of perspectives, from if they're holding an existing mortgage in a variable rate product. If they're an adjustable variable mortgage, it will help bring down their monthly payment costs. If they're up for renewal, it might actually push them into the opportunity of taking a look at a variable, which we've seen a lot of people choose that product this year as opposed to fixed because the forecast is bank primes to continue to drop this year and into next year. So I think that's a perspective. Plus, overall, there is a lot of confusion on bank prime and fixed rates. And when people see bank prime come down, they have the idea that it correlates with fixed rates, and it doesn't. It's 2 different metrics, and I know Bruno can talk about that in detail. but we continuously educate people that they don't correlate together. So a lot of people think that when this week there was no change in bank prime, that means that fixed rates won't come down, but that's not true. It's a totally different factor. So it's a personal choice what people take in terms of their mortgage product, but it's also everyone's situation financially is different from the next person, and we have to make sure when we're making decisions on if you're buying a house, is this a good time for you? Is it a good time for your family? What's your employment? What is your employment going to look like in 2, 3, 4 years from now, potentially? Do you have cash flow? Do you have some reserve savings just for, everyday expenses, not only for your house, but for life? So I think that even more so now, people have to be very diligent on their financing, but they have to really understand the economy at a high level to make some good decisions if this is a good time to buy or not for themselves.
Okay, Bruno, maybe you can speak to that, the fact that those two things aren't necessarily connected.
Yes, the 5-year fixed rates are correlated to the 5-year Bank of Canada bond. And that 5-year bond is tied very closely to the U.S. 10-year Treasury yield. So this is basically the government bonds, people invest. This is how they generate revenue. This is how they generate money for spending and so on. So the 5-year Government of Canada bond yield today actually fell by 4 basis points, and the 10-year Treasury yield in the United States fell by 10 basis points. So that would indicate, if those downward trend continues, some downward pressure potentially on 5-year fixed rate mortgages. So even though the Bank of Canada didn't change, because the variable rate mortgages are a function of monetary policy, which is the Bank of Canada, whenever they meet, they discuss lowering or increasing or holding rates the same. Today they held rates the same, so your prime interest rate, which is 2.2 on top of the Bank of Canada rate, stayed at 4.95. Didn't change. But the 5-year Government of Canada bond yield actually dropped by 4.3 basis points. And I think that has a lot to do with what's going on in the United States, to what Tracy indicated. Because we trade so much with the United States, they have a lot of influence on us. And when the 10-year Treasury dropped by 10 basis points, they had some employment numbers. Their ADP payroll numbers came out much weaker than market consensus. And I think that led to Treasury yield dropping. And then, of course, the Canada 5-year bond yield also dropped. So fixed rates are tied to the 5-year bond yield. Variable rates are tied to monetary policy and the Bank of Canada. Two separate things that may cause rates to kind of act inversely, but at times they do correlate to some extent. And if the Bank of Canada does lower rates very quickly, you might see the 5-year bond yield also drop. But they're not tied 100% together. Well, from my perspective, when we're looking at the market and we're looking at the labor market in particular, the labor market right now in Canada, because of the tariffs, because of the threat of tariffs, the on and off again tariffs, Canada in April unfortunately lost 31,000 manufacturing jobs. And the job numbers come out on Friday. Those numbers will be the May numbers. But when we look at the April numbers, our unemployment rate ticked up to 6.9%. It was 6.7%, and the market is forecasting 7% unemployment rate. And of course, losing 31,000 manufacturing jobs, that definitely impacts southwestern Ontario quite a bit, because we do have quite a few manufacturing plants. So,
Bruno, do they include if they're temporary layoffs? Does that factor into that number, or is that a non-issue?
Yeah, they'll include, I believe, all layoffs.
Right.
In general.
In a month, right.
Exactly. So when they're looking at 31,000 lost manufacturing jobs, that represents 1.6% of the total number of manufacturing jobs in Canada, and that's just in April, and we don't have the May numbers. So there's definitely a concern out there for income security, job security, how much of your job is dependent upon the manufacturing sector. Even if you don't work in the manufacturing sector, you might live in a community that has a lot of manufacturing jobs, and your job depends on them working because they shop from you, they buy from you, they go to your restaurant, and so on. So there's downstream implications to these manufacturing jobs as well, which is also unfortunate. We talked about the Bank of Canada not changing rates. When I did a presentation a couple of days ago, I talked about why maybe the Bank of Canada should look at potentially lowering rates. And one of those concerns was the weakness in the labor market, which I'm sure the Bank of Canada sees, but because they don't know the certainty of tariffs, I think they chose just to leave the rate alone and then wait and see. Because from day to day, they don't know what's going to happen, right? With steel tariffs going to 50% from 25 and so on, not knowing that that was going to happen. All that uncertainty is leading them to kind of sit back, I believe, on the sideline and wait and see how things settle.
And with that in mind, the instability affects the mortgage market and those deciding, do we move, do we sell, what do we do?
I think so. I think that this year in particular, as we know, everyone's looking at social media for education, advice, stories from people, like what they're going through. So when you take a look at that, I think that that's probably one of the biggest drivers I see for a lot of Canadians and potential home buyers, even homeowners right now, making some decisions on what they do, whether they sell their house and upgrade or sell and downsize, or even look at getting into the housing market as a whole. A lot of the information that's out in social media is so driving the negative out there. And again, there is a lot of uncertainty, obviously, with what's going on. But we've seen that, realistically for almost the last 5 years. I mean, if it wasn't what's going on with the trade war and tariffs, we were looking at high inflation the last 2 years. Prior to that, we had COVID for 3 years. Like, there's always been something that's pretty, pivotal each year that's really driving people's mindsets on making decisions. And I think that what's happening is people aren't looking at their opportunities and looking at themselves in terms of what's in your bank account, where are you employed, what area are you currently looking to buy in Canada, and make decisions based on what's best for them, because you could be missing out on opportunity. And so I think that it's really important more than ever that home buyers or people looking to get into the housing market speak to a mortgage professional, because we can really break it down. We can take a look at your credit, take a look at your income, see where you're at, see what your goals are, see what's happening with your employment, so that we can help make some good decisions where maybe you would have missed out on an opportunity because you get so struck by what's happening on social media, right, and driving that negative, right? And I mean, any market that we've seen, Bruno and I have been doing this a long time, and so we've gone through a lot of different inflationary periods, recessionary periods. The market does 100% recover. It just looks different, and we have to pivot during those times. But there's times where people have made a lot of money and a lot of investments through opportunity in real estate, or got into the house of their dreams if it's just, you want to own that house, and that during these times where you're able to take advantage of a buyer's market. And there's a lot of areas right now in Canada where it is a buyer's market, where we haven't traditionally seen it. Interest rates have come down. Like, I've gone through a comparison even from last year. We've seen interest rates come down over a full percent. Detached homes have come down in our area in Kitchener-Waterloo, about 16,000 on a detached home. And income to qualify on that has come down about $7,000. And your mortgage payments based on, because values have come down in your home, if you're making a minimum down payment, is almost about $600 a month. Like, that's a great win. And these wins have to be what's out in the social media right now. We have to talk about this more, not just always the negative driver out there. Like, here's some opportunity. Here's where your monthly payment could be lower and interest rates have come down. So maybe if you have the savings and you've got great credit or good credit and you've got the income, we can get you into a home, right? And speaking to a mortgage professional will help you do that.
Instability can work to your favor. And you
Absolutely.
made a really good statement about the fact this isn't one blanket scenario when someone is looking at selling or buying where you're at in life, and you even mentioned geographically maybe where you want to be.
Yep.
And maybe somebody even reached out a year ago and didn't like what they heard, but now it may be more ideal for them as far as qualifying.
Absolutely. And here's the thing. We're seeing a lot of people not just buy in our community. I mean, obviously, we've been in this, Bruno and I have been in this community for almost 30 years now. And I built an amazing business with beautiful clients from this community. But a lot of people are moving out for affordability, or their kids need to buy a house and it's just too expensive in this area. And so when we're looking at it from, from provinces, there's a lot of good development of real estate and wealth being built from real estate in areas that we wouldn't have really traditionally looked at in buying. Like Newfoundland, their purchase price have gone up 21%
Wow.
this year. Like, so, you got to look at, and it's definitely because of affordability, and people are still working remote from home. So if you're able to do that and get a lower price point to get into a house, that might be a big, an opportunity for people. We're seeing even out west, like not only just Calgary, but like Winnipeg has really picked up. Edmonton is still a hot area, not only to buy as an owner-occupied, but a lot of people are buying investment properties there. Plus, they're actually tearing down properties and building like 8 plexes because the rent there is where we can actually offset the rent that you're going to be receiving on that property versus your mortgage payment. So you're actually a lot of times in a cash flow positive. So there's great opportunities, and that's why speaking to a mortgage professional is going to give you the education out there of not just looking in our community, but looking elsewhere for real estate, right?
Yeah.
It makes a big deal.
I love that you made the point about, and you're so right, that we tend to, maybe we make notice of the negative news. That might be part of it.
I think so.
It's easy to skip over some of the positives, but there are plenty of stories of people that took advantage of a downturn or uncertainty and came out in a much better way.
Absolutely.
Okay, now with that in mind, the word renewal comes to mind. Any tips when it comes to if you're getting near or up for renewal?
So renewal is a big topic this year. It's going to continue on into 2026. There's like 3.3 million of mortgages coming up for renewal in the next 2 years, which is about 60% of the mortgage market across Canada. And if you look at it from 5 years ago to where interest rates are today, we're sitting at interest rates 5 years ago at about 1.90% on a 5-year fix, which we would all love to have now. We know that's not the reality of where we're at with interest rates. But looking at where rates are right now, there's definitely an increase in the interest rates. We're sitting at probably around like probably about 4.2 right now on a 5-year fix. So your payment's going to go up. But the thing is that equity is still in your property. Even though we've seen this up and down of values, increasing and decreasing during this time of, going through COVID, pre-pandemic, and then also going through inflation, we're still seeing, if you haven't touched your equity in your property in the last 5 years, and you're coming up for renewal, in a lot of areas you're going to see that you're going to build wealth through your equity in your property, and that will help you if you've got outstanding debt. So if you currently, and I see a lot of Canadians that have outstanding debt, such as credit cards, lines of credits, and we know credit cards, a lot of them are sitting at over 20% interest rates, and average balances overall that Canadians have on credit is they're holding about $70,000 worth of debt, whether it's a credit card or on a car loan. The average monthly payment on a car loan is about $700. And the interest rate, believe it or not, on a car loan on average is about 8%, because a lot of people got car loans during COVID and it was expensive.
Right.
So if we're able to pull out that equity, consolidate that debt so you're not so cash strapped monthly, and I'm seeing more Canadians cash strapped monthly than I've ever seen before. We're having a lot of people reach out to us even before the renewal date because it's really hard to manage their everyday expenses when inflation's still high on food prices, and they're paying these just minimum payments and not getting ahead on credit. So if we're able to consolidate that into your mortgage at time of renewal, or even before, we can look at that, and you've got the equity, and even though the interest rate is higher than where it was 5 years ago on a mortgage, we can go out to a 30-year amortization, and we can still keep your payment very similar, if not slightly higher than what you had.
What I'm getting from this, from Tracy and from Bruno, is that reaching out and asking questions. You may have questions. Don't make assumptions, but reach out and ask. ValcoFinancial.ca. Give them a call, 519-745-8019.
Well, I think that definitely there's a lot of volatility because of tariffs and because of them, to your point, being on and off again. And right now we've got the issue of course, the increase in tariffs up to 50% on steel and aluminum. But one thing that I think we all have to understand is that tariffs are a consumption sales tax, essentially, on imported goods. So when you say the word tariff, and we have the elbows up sort of narrative right now, in that we're defending ourselves, I think with tariffs, we have to be very careful to what extent we want to do that, because remember, a tariff is a consumption sales tax on imported goods, and it's sort of a regressive tax, meaning that if American blueberries are being tariffed, doesn't matter if I make $5,000 a year or I make $5 million a year, if I buy those American blueberries and there's a tariff on there, I'm paying the same as the person that makes $5,000 a year, as the person that makes $5 million a year. Meaning everybody gets impacted the same amount, but it's not relative to your income. So what does that do? The lower income people get hit the hardest, right? Because that increase in tax on those consumption goods, because their incomes are lower or even middle class, they're the ones that are going to be hit hard by these retaliatory tariffs. And I saw a graph, and I'm looking at it now here, and it's from Bloomberg, coming from Source Stats Canada, that shows that Canada in 2025 has already collected nearly $2 billion in tariffs. So tariffs fill Canadian government coffers up to $2 billion. Well, when a tariff is implemented, the United States doesn't pay that. The importer that's importing the blueberries
Right.
pays the tariff and then decides how much of that tariff they're going to transfer to the consumer, right? Are they going to eat the tariff, or are they going to transfer some of it or all of it to the consumer? And there was a recent survey in the United States of CFOs, and they felt that about 73% on average of the tariff gets transferred to the consumer. So almost 3/4 of it gets
Right.
transferred to the consumer.
Interesting. Okay.
So these retaliatory tariffs of $2 billion, using that methodology of 73%, you're talking about nearly $1.5 billion transferred to the consumer out of that $2 billion that the consumer will have to pay. So the manufacturer will import the goods, pay the tariff to the government, and then decide how much of that they're going to transfer to the consumer of that product that they're importing. And the United States, of course, has the same issue. The issue the United States has is they've launched these reciprocal tariffs on the so-called Liberation Day on April the 2nd against hundreds of nations, right? We're kind of only doing the retaliatory tariffs against the United States. I think we may have some tariffs against China with electric vehicles and so on. But the United States is doing this with almost every country that they trade with, if not every country. I think the minimum hurdle to export goods to the United States is 10% tariff, right? So they're collecting all kinds of tariff income, but then again, how inflationary is that as the importer decides how much of that to pass through? There was a big thing on Walmart in the United States where Walmart came out and said, I don't know if you heard about this,
Yeah.
that they're going to increase their prices. And of course, there was a social media post from the president. He didn't like that. But the bottom line is they're being transparent with their consumers and saying, hey, you know what? Our prices are going to start to go up.
Some of them were even going to put a T, weren't they, on the price sticker? Or at least I heard that.
There is some of that even in Canada, and I think that's not a bad idea. If you go to the grocery store, and remember, we don't typically tax food, right? Because again, it's a regressive tax. I mean, food is a necessity in life. But if we tariff imported food, we're essentially taxing food, right? If those blueberries get taxed because they're tariffed because they're coming in from the United States, I mean, that's essentially a tax. So yes, I would say that I think that Loblaws said that they would put some identifier on their...
Or one of the online store. I mean,
some of
probably a
them,
few
yeah. Well,
places
here
you
in
could
Canada,
do it.
I think you can, there are some stores that are going to be, I think it's a great idea. It's being transparent. Hey, listen, here's the price of this. And you know what? We're going to put a T there because you know what? That price is elevated because of the tariff that we, as an importer, had to pay to the government. And now we're transferring some of that cost to you, and we're putting a little T there to indicate that that is the case.
Some transparency, the same way at the gas
Transparency
pump.
is wonderful.
At the gas pump, you want to know, okay, so that percentage is going to tax and
Right.
what have you. So Tracy, when we take these numbers and you take the tariffs, and I know they're framed in different ways, but for somebody who's got a mortgage, thinking about a mortgage up for renewal, knowing that they're spending more at the grocery store, again, depending on their income, This can be a big variable to them.
It is, and I think it's even more so why you're seeing people really look at their budget. People should be looking at it all the time, being more financially savvy in terms of where they're spending their money, but even more so because people understand that tariffs mean elevated prices on certain goods and services, and they know that it's going to affect their pocketbooks at the end of the day. So what I'm finding is that in a good way that people are reaching out earlier on in terms of before they're even coming up for renewal or even looking to buy. A lot of potential home buyers are being really proactive to take a look at, okay, what does this look like for me if I'm looking to buy a home in Canada? What does the mortgage payment look like? What are my additional costs going to look like? What's the future of, property taxes going up? Where is the future of where my income could potentially be? So that they can make better decisions, not be cash strapped, because tariffs is, this ever-changing conversation of is it going to be implemented, is it not? And we've seen prices increase, like there's no doubt. I think it's great that we're seeing in the grocery store, we're starting to see these signs go up, but it's still causing overall consumers to be hesitant on making a lot of decisions because it's such an uncertainty, right? And most people haven't gone through that trade war, especially when they're buying a house or if they're, maybe they were a homeowner in the last few years.
Of course, my thought goes to first-time home buyers right now, and they're already on that edge of can we afford to do it?
Absolutely. So I think that the government's coming out with some good initiatives for first-time home buyers. If they're buying a new build up to 1.5 million, they're able to save up to it works out to be about 50,000 in HST rebate, so that's good.
Significant.
That
yeah.
is absolutely. It's still challenging for a lot of people that are first-time home buyers to be able to qualify for that home of 1.5 million. Most people's incomes aren't in that income bracket, so we're seeing a lot of first-time home buyers. I would say out of 10 of them, 8 out of 10 of them are having parents be co-signers or mortgage helpers, give them extra money for down payment, or even potentially have multiple friends come together to buy that home. So like it's a couple, two couples coming
Yes,
together
right.
to buy a bigger home, right? So we're seeing a lot of that. The other thing we're seeing as well too for first-time home buyers is looking at properties to maybe retrofit it so that they can have a income suite in the basement. So retrofit the basement as a separate apartment unit so that they can have a long-term rental tenant in there to help offset that mortgage payment, and that's been very successful for people. It also helps bring up the value of your home because you are putting in some renovations that property looks appealing. So if you do end up selling it down the road, there's potential income for another buyer, or maybe it's for a generational home to have your in-laws move into, right? So I think we're seeing a lot of alternative ways for people to look at buying a house than the traditional of, a couple just moving into a single detached house. We're seeing a lot more different structures and different opportunities for people.
Or for people, there was a day where even as a single individual, you could look at leaping into the house market. Now that just seems like, how would that ever have happened?
But let's talk about that, because I still think there's some good opportunity, and we're seeing that even right now. I had somebody single this week that came in, and they thought that they were really out of the market space, but once we got them pre-qualified, the condo market has a lot of inventory out there. Whether you're in the Kitchener-Waterloo area or in outskirt areas in Ontario, there's a lot of opportunity to buy a condo right now, and to see it in the price ranges that we traditionally have not seen. Like for a one-bedroom condo, we can see now that price point being around $350 in some instances. That's a great starter purchase price for a home to be able to get into. As a condo to start out, you have to remember we have to build up with real estate. It's not the big detached home.
Right,
Everybody
right.
would love to have that. The reality is, Bruno and I didn't start that way when we first bought our home. We bought a semi-detached home.
As did I. Yeah.
And then we moved up. Right, we were there for a few years and then moved up. So buying that condo today at $350,000, you have minimum down payment. Your payment's more manageable, and we can get you to qualify when you've got that starter income, right? When you first started your your job. So there is properties in that area, and it's surprising when we show people this, the opportunities that are out there. They don't see that because, again, the social media is not driving those opportunities for people. It's driving, oh, look, these houses are, $900,000, $1 million. You can't qualify for that, right, on a single income.
So you know where you go to hear those opportunities? You contact Valko Financial.
Absolutely. I say this no matter what market we're in, you have to make sure if you are looking to even have the idea of buying a home, you really do have to get pre-approved. So you have to speak to a mortgage professional so we can sit down and educate you on what documents we need so that we can look at your financing, look at your income, take a look at your credit, so we can give you a good idea of how much you do qualify for to be able to buy a home. I always use that analogy, you can't put the cart before the horse. So to have these steps in place, it'll help you have not only where you're at in terms of that price point to purchase a property, but it helps give you where your actual payment will be on a mortgage so that you can understand that in your budget. And then you'll have a good idea when you're speaking to a real estate agent and starting that home buying process of what your maximum can be on that price point so that you're not overlooking at properties that you potentially can't afford. And it really sets the expectation. So setting the expectation and understanding where you're at with your financing is going to get you that path of home ownership. So making sure you speak to us first. And a lot of people don't really understand how they get paid with their employment. And I don't mean that to discredit people. It's that we're very busy in life and people could have shifted their ways that they had get compensated within their company. They could have been full-time and maybe it changed over to contract because it was just, their position had adjusted, and they're not taking that in consideration. For us to take a look at that to help people work out how much they qualify for, because incomes are not only one income. We see a lot of people working 2 to 3 jobs. So what does that look like for you, and how much can we use of that income to help you get into that home that you want to get into? And that's the biggest challenge, but also opportunity for people, because we can help them manage how they're getting paid better and maybe direct them in a better way so that they can qualify for that property. And I see that specifically with people that are entrepreneurs, so they may have a full-time job, but they've also started a side business as well, and educating them on how to be able to show their income in their bank statements, and also what impact that's going to have on their taxes, so we can get them to qualify. It's really about education. Education gives people clarity, it gives them guidance, and then it gives them calmness when they're looking to buy.
Okay, so there's obviously the part about needing a roof over your head, but, and maybe, Bruno, you can speak to this, also as an investment. I mean, real estate is an investment. Is this a good time to invest, or should we be waiting for rate cuts, more market stability? I mean, it's kind of like, as you pointed out, Tracy, there's always going to be something
Absolutely
causing instability. What do you think about that, Bruno?
Quick correction on the blueberries, they are exempt from tariffs.
Okay.
Substitute them for orange juice, which apparently is not exempt. So I want to kind of deflect a little bit on that. So when it comes to buying a property, I always think of when Tracy and I bought our first home. We bought our first home not because we thought of it as an investment. We thought of it as a place to live. We were renting an apartment in Toronto. It was a 1-bedroom, very tight. Our son was just born. We needed more space. So the opportunity to move from Toronto to Kitchener and get a semi-detached home on East Forest Trail, 3 bedrooms, nice backyard, close to at the time it was a brand new school, across the street from a park. That's what we were thinking.
Quality of life.
Quality of life, raising your children, having the backyard, having the school, having the park. Affordable payments, of course. That's where you talk to your mortgage professional. But I wasn't thinking about the future value of that house. Is it going to go up? Is it going to go down? I was thinking about it as a place to raise my family in a safe neighborhood and being able to buy a home. Because remember, when you buy a house and you have a mortgage and you amortize it over 25 or 30 years, every month you make a payment, you become a little bit richer because you're paying some towards your principal, right? And as you pay your mortgage down, then you build that equity in your home. Now, these days it seems to be that people think of it a little bit differently, but Tracy touched on something very important for everybody to understand. even though interest rates are higher now than they were 5 years ago, and if 5 years ago they were 1.9 based on qualification, let's say you can get 4.25 now, seems like a lot higher. Well, why is it more affordable now? 5 years ago, if you were a first-time home buyer, you were on a 25-year AM. Now, if you're a first-time home buyer, you can get up to a 30-year AM, and your house isn't $900,000 or $950,000 like it might have been 5 years ago or 4 years ago. It might be less, right? So because the peak market in the Kitchener-Waterloo area was Q1 2022. That's when the values were at their highest. So call that whatever, 3.5 years ago. And the market was crazy. There was tons of offers. People were tripping over themselves. You had, like, Tracy can attest, there were 40, 50 offers. Now, Tracy mentioned it earlier, it's more of a buyer's market. There's a lot of listings. You can potentially maybe shop around a little bit more. And that house that, say, 3.5 years ago cost $900, $950 might get you now, maybe you can get that for $750. Will it go up or down in value? Well, we don't know, but can you afford the down payment? Is the payment good based on a 30-year AM? And then when you compare the two scenarios, even that same house, because values have come down, it could actually be $300, $400, $500 less per month for virtually the same type of a home that you could have gotten 3.5 years ago when values are at their peak. So even though rates are a little bit higher, that affordability of buying a home to live in, raise your family, quality of life, to your point, it could be beneficial to you. And you know what? The opportunity to work, with a realtor and a mortgage professional to be able to shop around and not having that urgency from 3.5 years ago of 40 offers and everybody like outbidding each other and the craziness of that it was. You can sit back maybe a little bit now, shop around, look at different homes, and pick the home that you're comfortable with, knowing that the payment is affordable for the next 5 years if you're on a fixed rate mortgage, close to schools, so on, like I mentioned.
I think the other big thing with this is that nowadays, because there's more inventory, there's more options for people, when you are a first-time home buyer, or if you're looking to upgrade your home, you have the opportunity to put in subject to financing, subject to home inspection. It gives you time to take a look at your financing, get the appraisal done on the property, make sure the value that you're actually putting in on your offer to purchase is there and going to be accepted by the lender. And we really haven't seen that in our markets before. It's been, sometimes people have bought a property sight unseen, right? In the crazy times. Yes. That's something that I think people are not understanding, how it's such a blessing to have that nowadays. And having said that, I have to tell you, like in the Kitchener-Waterloo area, specifically detached homes right now, it's still a very busy market. Like if you look at properties in that $600 to $850 price range, which is pretty wide, and you have to remember values have come down, so you have a lot more opportunities out there of looking at these properties because there's more supply. I've seen it, and I saw one last week that there was over 51 offers on the property.
Wow.
There was an open bid on it, and there was 51 offers on it. This is where people are not seeing that, because we're again seeing this, oh my, there's so much inventory, rates have gone up, tariffs, trade war, unemployment's gone up. And so there's that chaos that everyone's listening to. But then there's this where the actual market is pretty chugging along well. Where we're struggling a lot is in the condo market, because we have a lot more inventory. There was a lot more micro condos that were being built right across Ontario. And a lot of them are actually coming up to be completed now. So they were pre-cons from like 3 years ago. People bought them. The market was, a lot of investors bought them for opportunity. And now those values have come down quite a bit. So that's where we're going to see some fallout. But then again, there's opportunity for first-time home buyers to buy a condo for $350,000. And maybe in a market where we would have never seen that. So I think that there's still some there is stability in the housing market. It's depending on the type of property and the location. Kitchener-Waterloo, I've got to tell you, is this pocket that we don't see really on the outskirts anywhere else. Guelph, yes, it's still busy. But if you look at Mississauga, Burlington, the GTA, if you're looking at London, Stratford, Woodstock, and going into Windsor, it's a lot slower market, right? The values have
Right.
come down. It is a lot slower. There's a lot more, I think, outlying effects to the market and why people are not buying there, or values have come down. I think tariffs hit that more because of, again, there's a lot of like sectors that are completely impacted by that. More manufacturing, steel and metal, especially Hamilton, you're going to see that, you know, values are coming down. And I saw some forecasts of next year in terms of the housing values in Ontario, and there's a lot of pockets where we're going to see those decreases. But then again, decreases will bring the opportunity of seeing potentially rates coming down. And rates coming down is going to help people afford houses more, right? It'll help people. When rates come down, the market moves better. But here's the thing, we've had rates come down, and actually the market's moving pretty good here in Kitchener-Waterloo. So I think that's a game where you've got to speak to a mortgage professional and a realtor that really can sit down and give you actually the stats out there, because there's a lot more opportunity and the market's a lot stronger than actually what I think people think.
I think you both brought up some great points, and I think sometimes we suffer from the one relative or neighbor that said, well, here's what I've heard, and
Exactly.
they take that as just professional advice. I would suggest that you reach out to Valko Financial.